Well, hello, Bonnie.
Hey, Matt, how's it going?
Having a good day. It's hump day, middle of the week. Middle of the year, middle of the week, all kinds of stuff going on. Almost completely done with the second quarter, and I swear this year has felt like it has been 5 years combined into one with all the crazy volatility we've seen this year. It's been pretty nuts. I don't know about how you're feeling about that, but I have felt like there has just been so much change going on for ourselves, for our clients, all kinds of stuff. Are you feeling that same thing?
Yeah, absolutely. It's like, I can't believe it's already almost July and 6 months have gone by, but it also feels like it's been a really long time because of everything that's been going on.
Right? It's kind of crazy. Well, let's go ahead and get started here. For everyone who doesn't know, I'm Matt Garrett. I'm the founder, CEO of TGG Accounting. We are an outsourced accounting firm that aims to make accurate, timely accounting affordable. Rather than having to hire full-time outsourced folks, we work with your staff. We can also augment by helping you hire existing staff, and we can help bring in process procedures and or completely outsource the whole thing to us in a way that is the most efficient and effective way for you to get accurate and timely data so that you can make good decisions and hold your people accountable for progress. I've got Bonnie with me. You might be familiar with Bonnie from a previous Bonfire Chat session. Bonnie is a CPA, CFO here at TGG extraordinaire, client wizard, and we are very lucky to have Bonnie with us today to talk about this absolutely tip of the spear kind of conversation on inflation. The Fed told us back in March that inflation was transitory, that it wasn't really going to be here for very long. And I don't think anybody believes that anymore. If anything, I think the biggest fears are somewhat coming true, that we see inflation and we see an economic recession. So I think this is on the forefront of everyone's minds that I talk to. Bonnie, we're going to talk about what you see out there in this inflationary environment and what you see are ways that we can actually help people move forward with their businesses, be successful, protect themselves in this time. And I want to make sure that we really give these people some tangible takeaways today, some real things, some to-dos that they can use in their business to help, again, move them forward towards their goals. So are you ready to get started, Bonnie?
Yeah, let's do it.
All right, let's get moving. So my first question here is what are your top strategies for tackling this inflation situation that we've got going on?
Yeah, sure. So I'll go through 5 specific strategies, and then we'll get into even more kind of in 5 buckets that these strategies relate to.
Okay.
So the first one is probably the most obvious one to everyone, and that has to do with your prices. So raising prices, right? But we want to get a little bit more strategic than just saying go and do a blanket price increase for your customers, right? Normally, I would advise my business owners to review pricing strategy annually. Now we are in a position where it should be reviewed monthly, maybe weekly, depending on your industry. We should be looking at our profitability based on the cost of our inputs right now and determining what price do we need to charge, right? Ideally, in order to make the margins that we need to make. And when we do that, we might discover I need a 15% price increase for certain items, right? Or certain customers. Does it make sense for me to have that price increase all happen next month? Or can I stagger it out and sort of incrementally implement this over 3 months, 6 months, right? So those are the things we kind of want to be thinking about.
Yeah, it's interesting that you mentioned that sort of incremental price increase. I was on a Zoom meeting reviewing a set of financials with a manufacturing client, and the woman who owns the company, I was seeing this steady erosion of her gross profit margin from 35% down to 29%, but it was like death by 1,000 cuts. So it was like the people were doing that to her. And she said, yeah, I don't really remember any price increases. And I looked back and we started to dive deeper, and it turned out they were increasing prices at like 1 to 2% a month, which 1 to 2% a month doesn't sound like a ton, but it adds, it really compounds on it. And that idea that we should be doing that, right? That we should be incrementally thinking about price increases, not just once a year or once a quarter, but all the time, I think is a great one. What's some other ideas?
Yeah, I also on the prices, I want to say that this is a lot of business owners are hesitant to do this, right? Because it comes at the risk of customer loyalty. But right now is a time where, unless you are living under a rock, everybody is expecting prices to increase, right? You turn on the news, all you hear about is inflation. So it should be a little bit of a softer blow in terms of if you are a business owner and you're nervous about those conversations or making a move like that.
Yeah, I think that's another good point. And I know as a business owner myself, I'm always nervous about losing customers to price. When we're doing a great work and we're doing everything, you don't want to lose them to price. Golly, that seems silly, but it is a good point. Like when you go to buy that steak and it's 30% more, we're kind of expecting that same thing across the board. So good point. Good point.
Yeah.
All right. So what else?
Yeah. So second idea is to invest in automation. So this idea directly addresses the cost of labor increases that we're seeing, right, as part of this overall inflation. Now's a time where if in the past you looked at, let's say, some machinery that was going to be help your warehouse gain efficiencies, or even something like a robot, right, for your warehouse. This is what Amazon's using right now. If in the past you maybe looked at that and said, that's too expensive, we've got people to do that, right? Now we might be getting to that tipping point where your cost of labor could be more expensive than those machines, right? Or those robotics or technology, right? Or really anything that you could be investing in that is automated and not people. It's a good time to be looking at that cost benefit and seeing if that can save you some money. And it's also a really good place to spend cash if you have excess cash, right? Because what's happening in an inflationary environment is that our cash is just devalued every day that's sitting in the bank, right? So if you have that excess cash, it's a good time. You could spend it on that and then employ less, not have to worry as much about the labor increases and gain efficiencies.
Yeah, this is another common one that I hear all the time is labor rates are going up and going up and going up. And to like sort of compound that problem, not just labor rates are going up, but the great resignation is still kind of has a hangover. Now, I think that's changing with unemployment ticking up, right? But I do believe what you're saying is spot on. And at a point, we need to think that the crazy stuff that was science fiction 20 years ago might be our reality. I'm reading this great book right now called The Exponential Age. And in it, the author talks about how these technologies are developed by the Amazons, like you mentioned, of the world that are robotics. And we think, oh, we can't afford that. And 2 years ago, we might not have been able to afford it. But now that technology and the efficiencies might have gained to the point where we can actually afford it. So I would encourage everybody in just about every industry. In our industry, for example, in accounting, Bonnie, we're looking at data entry automation. And there are certain technologies that didn't even exist 2 years, 3 years ago that now we can use to help increase accuracy, decrease cost. And again, with all this turnover happening and increased labor, I think this is a great comment to really think about what technology might have been out of reach before, but now maybe is something you can use. I think that's great.
Yeah.
That's great. All right. What's another one?
Yeah. So another one is to create a competitive edge using some kind of hedging. And so what I mean by this is doing something where you can lock in prices today to create stability, lower risk, and predictability in your profits. So for larger companies that I might work with, let's say 20 million in revenue or higher, typically ballpark, this might look like investing in futures contracts. So if you are using some kind of a commodity, steel, grains, soybeans, any other type of metal, you could invest in futures contract. Fuel, that's such a big one right now. And basically lock in a lower price and create a competitive advantage, because not all your competitors are doing that, right? They're going to have to charge more to create the same profit. So that's one way. And for my smaller businesses out there, this would look like doing something that I do not normally advise to do, but in this economy, I would, is to make sure you have plenty of inventory, right? So maybe buying ahead. So this idea, the just-in-time inventory, the very efficient inventory method in this environment, we might want to go more toward, let's make sure we have enough cushion for demand so that we can get lower prices today.
Well, that's another thought too, is as you spurred a thought in me of like getting that inventory on hand means we might be able to charge higher prices for just-in-time inventory for our customers.
For sure,
right?
Yes.
Where our competitors might be saying, well, we can't because of the supply chain issues. If you've got it, you can charge more for it today and take advantage of that situation. So that's a great one. I really like that. That's a great one. What's another one?
So next one is going to probably involve your accounting department helping you out a little bit, but having an idea and paying attention to your profitability in 3 areas, depending on your business, based on product or your SKU, based on your customer, and based on your sales channel, right? So what I mean by sales channel, if you are a retail e-commerce company and you've got online sales to customers, you're selling wholesale through Costco, you're doing some B2B stuff, looking at all 3 of those different channels, right? Because the input costs for our channels, our products, and even for our customers are going to be different in this environment. They're going to be changing. So having some kind of a dashboard to be able to see, right, which of these are above kind of our target overall profitability, which are in our upper echelon, kind of our premier products, customers, or channels, and really focus our efforts on that, prioritize shipping towards those, because it means that you're going to get more cash on the dollar for that coming in if you've shipped and invoiced sooner on those. So this is like gain some visibility into profitability.
So I love what you're talking about in terms of profitability by unit. It works for service businesses as well, because profitability by service line, profitability by employee, very important stuff to make sure you understand that if you're in a service business, not just product business. But one of the things you said that I thought was really important in there, Bonnie, was thinking about your customers and starting to do customer segmentation analysis. So what the same woman that I was talking to earlier this week on Monday, it turns out 80% of her revenue is coming from 20% of her clients. She's got a lot of little clients. And I said, okay, well, are those important? She said, yes, because sometimes they'll pop and they'll become big clients in a year and you never really know. She goes, but there are some clients that I don't really want to work with. And I said, well, those are the ones you can go and increase price on now, because if you increase price on it, you make so much money on it, it's worth dealing with. If you increase price and they leave, okay, no problem. So let's start there. So tying it back to kind of your first point about price increases, maybe customer segmentation can also help in identifying where to increase prices, not just blanket across the board increasing prices.
Yeah, I love that. That is such a good point. That's a great idea.
Thank you for saying that. All right, you said there's 5. I've got, let's see, we've got, so far we had adjust prices incrementally rather than all at once. Thinking about that. Automation and technology, investing there, creating competitive advantage through hedging, where again, I think both the technology and the hedging, people used to think, oh, we're too small for that. We're not big enough for that. I've seen it done, as you said, 20 million, but I've seen even that hedging done as low as $10 million revenue companies, and the automation might be there for anybody. So good thoughts there. Then the 4th thing that you said here, pay attention to the profitability of products, customers, channels, et cetera, and try to do customer segmentation to understand exactly where your profitability is coming from. Focus on those areas. What's your 5th?
Yeah, so the last one is really high level, kind of all encompassing, and is timely considering that tomorrow's the last day of the month. We're going to be revisiting our business planning right midway through the year. We're going to be reforecasting out the next 4 quarters. And that is to go back to the drawing board and really focus on what are my core competencies? What do I do that I know I can make money? Right? So some ideas that you have right now that could be kind of risky. So I want to open multiple locations. Maybe it's not the best time for that. And we hold off, we kind of pivot, right? Our strategy. So it's just time to go back to the drawing board, focus on what you're really good at and what you can make money doing.
Yeah, I like that, Bonnie, a lot. It's a great idea of just not to get too diffuse and too diverse. And I want to kind of piggyback on what you're saying in that, you know, it's focus on the core competencies is what I hear you saying, but it's not necessarily being passive, right? It's not like pull your horns in and just slow down. It might be, in fact, accelerating marketing spend, but in fact, tracking marketing ROI.
For sure.
It might be going through and hiring new business development people, but it's really making sure you're holding them accountable for that base marketing metric, meetings or proposals or whatever it is that they have to do. So I really like that idea as well of focusing on your core competencies as we go through. Now, as we're going through this also, I want to make sure that our audience understands, you guys can throw any questions you want for Bonnie, myself, into the chat, and we will make sure that we get to them as we're going. Because one of the things that I saw in here was from my good friend and former TGG ambassador and great overall amazing human, Craig Goldberg, said AI is touching everything right now, a lot of innovation there. And it's one of those things that reminded me as he put that in there. We're looking at using AI automation to start to use to automate processes like payroll, like your rent payments, things like that, that you can actually build technology, custom technology for you that, again, most people thought was way out of reach. But I've talked to 3 different firms now and gotten pricing from them on how we can start to automate some of these things for our clients. And so I think Craig's point of AI touching everything is true, not just in my business, in the service business, in our business, Bonnie, but manufacturing, medical field, all sorts of stuff. And it's time to really focus on some of these things. All right, so Bonnie, it sounds like there's 5 things that you really wanted us to focus on. What do you really see then as, if we're going to kind of, I don't know, bucket this thing into different areas, and can you keep on this brainstorming thought? What are the sort of big buckets where you'd put these things into strategies?
Yeah, so the things that we need to look at are your customers, your vendors, your employees, financing or capital structure, and business planning. Those are kind of the 5 big overarching areas.
So let's talk a little bit then. Customers, sorry, can you do that one? Customers, yeah. Vendors, employees, financing. What was the last one?
And the last one is business planning.
Business planning. Okay.
So like future looking. Yeah.
So if we're looking at our customers, what are you seeing your clients do to both support their customers, continue to add value, but also go to your kind of initial thing on price changes? What unique strategies? Everybody knows, oh, we'll just increase prices 5%. Okay. What sort of different stuff are you seeing in different industries that's helping people get these price increases?
Yeah. So I've got a professional services firm that I work with. They are a bunch of consultants, and they have added on a project management fee to their invoices. So thought about it and said, there's a lot that we're doing that there's a lot of value we're adding that we're not charging for, and came up with this additional fee. It's built into the contracts now with new customers. If customers say, oh, what is this? And ask questions, there's room to negotiate from that 10%, right? If it's a massive customer that we're going to exchange, right, volume for that fee, it might make sense, but at least getting it in there in the contract is helpful as kind of a place to start. So that's a kind of a unique fee, because there's other fees like a fuel surcharge, charging for shipping and handling, and more for that. Something else that's pretty creative is, and we had talked about this a little bit, but like dynamic pricing, which is the best thing I can think of is something that happened to me the other day, is like Uber's surge pricing, right? So you get an Uber at Friday at 7 o'clock at night, it's going to be way more than Wednesday at, 2 p.m., right? And depending on your city. So the way that some of our clients can do this is kind of what you were talking about earlier is, hey, if I am providing access to inventory for people that they don't have elsewhere, right? Because I got it faster, I hedged, whatever it is, I bought it in advance, I can charge more for that, right? There is a premium on that because I have the inventory available, others don't. Expedited, like getting orders out faster, whether that's delivering by truck, whether that's delivering by air, all of that we should be looking at charging more for. And then I've got a client that's e-commerce, and something that they've been doing is they found out a way to create a new, slightly different version of a product that already exists that's little incremental cost, but because it is this new product, it can charge more for that, right?
Yeah, what I'm also seeing, we talk about dynamic pricing. First of all, I love that idea. One of the things that I love about our service, Bonnie, is you get to see all these different industries and apply principles that they're taking from one to and bring it to the other. You see something going on in service business, like a service fee. Well, that can apply, or management fee, that can apply to construction too, where you can tag on a construction management fee. The other thing that I'm seeing people doing is that their pricing is only valid for a shorter period of time. So while, in the past, pricing might have been valid for 30 days or 60 days or 90 days, a bid on pricing might now only be valid for 2 days, 5 days, right? You can also make your pricing available, start to use pricing as a sales strategy. One of the things that I saw another client of ours doing is saying, hey, we might be 3% higher, but sign now in the next 2 days, lock in today's pricing. You don't lose money in the long term. And by the way, we'll give you a 1% off. So you're not really 3% more, you're just 2% more. And you're locking in these future prices. They've increased sales tremendously off of this strategy because none of their competitors are doing it. So it's taking pricing and turning it not just from how do I charge more, but how do I differentiate myself and be different so that I can actually increase sales in this kind of a time and increase prices. And I think that's pretty dramatic stuff. So I love what you said there. What about now? The other one you said was vendors. So what look, if it's good on one side of the coin for us to help our customers increase their prices, how do we actually do the opposite with our vendors? Or do we? Is there a way that we can actually deal with these increased prices and still be okay?
Yeah, there's definitely some ways. So I think just first and foremost, it's really important for businesses and business owners to understand the entire supply chain. So know who your suppliers are and who their suppliers are, right? From start to finish, to kind of identify along the way, where are you more susceptible to the effects of inflation, right? Because if you look at like the producer price index, that varies depending on what the product is. I mean, it's all over the place. So you want to really know from start to finish where, right, their one input might be at a 20% inflation rate and another might be at 5, right? So kind of understanding what's happening there and seeing where you can pivot, getting creative. Can I replace one material with another, right? So thinking about.
So that's an interesting thought, Bonnie, because, you know, I'm just echoing in the back of my head is Chinese shutdowns. Like
I know, exactly.
Shutting down every other week.
Yes.
And at least the statistics that I saw is that China produces 1/8 of the world's raw material products flow through China in one way, shape, or form. Yeah. Right. So most likely something is coming through China. And are you saying that you're helping clients research that supply chain, their whole supply chain, to figure out what's a valid price increase and what isn't, and try to then work with the vendors to help them make more money, but also get you a cheaper price?
Yeah, exactly. And I mean, and what you're saying is important too, to bring up here is vendor relationships are more important now than ever. So having consistent, proactive communication with them, right? Really being partners with your vendors is important. This is going to help in terms of negotiating. This is going to help eliminate surprises that come along the way. So really making them partners during this time, if you haven't already. And that's just a good business practice in general.
Yeah, I think it is. But, you know, the last 10 years, we've gotten a bit complacent because it's been so level, right? I mean, everything's just been kind of easy, you know, stable, steady Eddie stuff. And now all of a sudden there's no stability, right? Yeah. It's all over the place. And our vendors, I guess what you're saying, and the other thing is what if we could provide stability, as I'm saying this, to our vendors in some kind of long-term contracts? Maybe we could take on a little more risk as the customer of these vendors, give them some stability over time, help them maybe with their hedging on their materials costs. Maybe they hadn't thought about that. Maybe give them some strategies and ultimately get them more business, more profitable, but also then get you a consistent supply chain. One of the questions that came through here was how do I manage how do I manage when I just can't get products from people? And I know you've seen this, Bonnie. So what are you seeing as workarounds? Let's assume that you can't get them for whatever reason. What are you seeing as workarounds that people are doing to help mitigate some of these issues?
Yeah, I mean, I've got customers that are just taking pre-orders from, I've got clients that are taking pre-orders from customers. I've seen that, but in that case, it's, you know, like we were talking about, and this is something I wanted to bring up to you, Matt, is what do you do if you sell to customers today and you can't deliver it for 6 months, but 6 months down the road, you should have charged way more than you did.
Well, I think this is a big issue, and it's a real issue, especially in things where you don't lock in your prices. So one of the key things that I would tell people is if you're going to take pre-orders, pre-sales, like think Tesla. This is a great example of backlog, right? Tesla, if you go to order a brand new Tesla, you're waiting 6-9 months. They're like guessing. They're like, I think it's going to be 6 to 9 months.
Yeah, exactly.
Right? Maybe. But what, at least the way that I would handle this is if you said, this is the price we're going to lock in today, then you've also got to lock in prices with your vendors at that same rate.
Yeah.
So it's a huge advantage to your customers if you can lock in prices, because then they're not going to get hit with inflation. But you need to do the same thing. So you need to get a little bit higher gross margin if you're going to lock in those prices. And then you need to match up the contracts that you've got on from your suppliers with the contracts that you now have with your customers if there's pre-orders. And I've seen this over and over. It's a great way to get around this. It's also, frankly, Bonnie, a great way to elevate your brand. Nobody thinks Tesla is a cheaper type of a car because it's on back order. They think they think it's a nicer car. Ooh, yeah. Demand, right? So I think some of this is also how you discuss it with your customers on why you're in these positions and what else you're going to do for them, how to create a longer term relationship with them. So I guess my point is that I love situations where it's heads I win, tails I win. And I think you create those by looking at all problems as an opportunity to deepen relationships and increase profitability. Figure out how you can do it in those situations. So I love your ideas there. That's great. What the other thing we talked about and in your buckets here was employees. And we see this in the accounting world. I see accounting, I hear horror stories from our even people that I just talked to when I'm out speaking or doing whatever is, oh yeah, I hired my last 6 months I've had 2 controllers, both quit within the first 30 days. I had, then I brought in this person to do my books and they stink. And then they just took a job for 20% more than I was paying them and they just left and didn't do it. This isn't just accounting. I mean, I'm hearing this all across the board, but obviously we're feeling it in the accounting world too. What are you seeing as employment strategies that people are following to help mitigate some of these, again, these great resignation issues and the inflation, wage inflation?
Yeah. So what I'm seeing happening here is I'm seeing my clients skew compensation more towards variable comp. So more towards incentive-based comp, right? That is, for almost all of my clients, that is something related to profitability. So having, some kind of, profitability targets for people or for their divisions that need to be hit. And then you get a certain percentage of that, right? And that can be your CFO, your controller can help you determine what that kind of profit mark should be, right? Like, where do we need to be? And anything above that, we can pass on to employees. There's also ways that are lower cost or no cost that you can add benefits for employees that will make them feel a lot better about their job. Letting people work from home is an idea. So if you've got a business where everybody's coming in, if you let people work from home a couple of days, that might really help with their work-life balance and overall their loyalty to the business. You could, shift your PTO from 2 weeks paid to unlimited, which ultimately you pay out less if somebody leaves in that case. And all the studies that you find say that people don't take any more PTO on an unlimited policy than they do on, a limited 2 to 3 week policy. So those are some ideas for other sort of non-monetary benefits that you can.
I really like this. And this morning I was actually on a Zoom with one of our banking clients, credit union. And one of the things that they're doing is they're using technology automation to let people work from home. So effectively trying to drive more of their customers to using the technology-based platforms, online banking, apps, these kinds of things. Now this is banking world, but what can we do if this is manufacturing or other places? How does the intersection of technology and this work from home thing come together to overall decrease our overhead costs, decrease our rents, right? Is there a way that we can find some way to do this? And that's where I'm finding a lot of my clients are really driving at like what you said is no cost benefits, right? It doesn't cost you any money. In fact, it saves you money if your employees can work from home, as long as they're still just as effective.
Right.
So that's where I think what I'm hearing you say, Bonnie, is almost like this mesh of things, right? You can't just do one. But if you go to more incentive-based compensation, output-based compensation, pay them more for achieving more, profit bonuses, like you said, that kind of thing, and work from home and technology automation, and you weave these together, ultimately, maybe you can increase retention and increase profitability at the same time.
Yeah. And I mean, when you think about, employees today, especially in post-pandemic, it's like money is going to always be important to them, but there are other elements of the business that could be more important, such as the culture, such as some of these other benefits. I know, at TGG, we started offering employees a holistically membership. So now I get to go to spin class and TGG is paying for it. And it's awesome. Right. And that's $50 a month per employee. So, or 25. So there's some other things that you can get involved in, benefits you can add for employees that aren't going to break the bank in the way that a salary increase would. Or just, I mean, you touched on this earlier, but really the cost of turnover is the most expensive here, right? Because the cost of bringing on somebody in the same position externally, they're going to come in asking for more off the bat.
Yeah.
In almost all cases.
No, cost of turnover is massive. It's massive. Yeah. And I think the challenge is that, like, again, like we talked about in the accounting business, it's just something that's happening.
Yeah.
And so, like I said earlier, I always like to kind of go with the tide. The other thing that I will say is the cost of turnover is horrible. You want retention. But the other side of the coin here is, are you managing your employees by objective metrics?
Oh,
right?
Sure.
I find this is a major problem where people are like, oh, I love Susie, she's great. I love Johnny, he's great. But what are they doing?
Yeah.
Right. How effective are they? Because a C player is costing you money. An A player is making you money. And if we let C players stay, that's a problem. It's a long-term problem. What I was saying before is that ultimately C players are costing you money and A players are making you money. Yes. So I think it's very important for business owners to get realistic that some turnover might be necessary
for sure.
in their businesses, because they need to hold their people to a higher standard. If we're going to let them work for remote, do all these other things, give them profit bonuses, we actually have to hold them to the highest standards. So, all right. One of your other buckets here was financing, Bonnie. Tell me a little bit about what in an inflationary environment you should be thinking about. You as a CFO, what are you looking at when you go into companies to help them with their financing?
Yeah, so I'm looking at their capital structure. So for most of my clients, that's some mix of debt and equity, mostly debt. Having my teams go and look at our loan agreements, right? What's the default risk on our loans? When are payments due? How long? What are our interest rates? Like getting back to the drawing board on like the basics of our loans to determine, is our current debt structure too risky for this environment, or are we safe? Do we have enough cushion, right? Because if the risk of default is such that it could knock out my business, then I might want to look at getting some other type of financing. I'm also, interestingly enough, for companies that don't currently have a line of credit or maybe don't need one, I'm advising them that now might be a good time to take out a line of credit just to have it. It is going to be cheaper to spend your cash, right? So if you got cash on hand, spend that, invest that in any of the things we were talking about, right? Whether it's new employee benefits, automation, marketing, and then use your line of credit if you need cash to kind of bridge any gaps between, collections from customers, because that interest rate is going to be lower than your the rate of inflation. So also it kind of similar, but if you're looking at financing, long-term capital expenditures, we wouldn't use a line of credit for that. We'd use some kind of a term loan that's longer to match the asset. So in that case, it's like even if you aren't planning any capital expenditures, now might be a good time to take out a loan to buy those, because you're going to get that item or that equipment at a much lower cost today than you would. Now that's a tough decision, choosing between, taking a loan now before money devalues or waiting until things get cheaper. And so it's tough. So definitely talk with your CFO about that.
Yeah, it's interesting. I was talking with another one of our CFOs, Andrew Ruff, yesterday, and those are awesome, Bonnie. And I really appreciate you talking about getting a line of credit now before you need it. Like that's something that's so important to think about, lining up your financing properly, thinking about fixed rates today. If you can fix a rate and get a longer term, deal, I think people ought to take a look at real estate as well, because real estate financing has gone up quite a bit, but it's predicted to continue to go up. So what can you do if you're in an adjustable rate mortgage, not just at your house, but maybe you're in a higher interest mortgage or lower interest mortgage that's going to adjust think about what you can do on that side. But what I was thinking about as you were saying this is two things that are non-traditional in terms of financing, and that is AR and AP. Like when we give people terms, our customers terms, and let them pay us slower, we are being the bank, right? We're just not getting any interest on it.
Yeah.
So one of the real things that I think we need to start considering here is focusing on our AR policies and procedures, focusing on our contracts that we have with our customers, and make sure that there's enough teeth in there. Because the worst thing that we can do is do a bunch of work or provide a bunch of product and then not get paid. So making sure that we've got good, solid terms inside of our contracts so that we get paid, and try to really decrease that time that it takes for us to get paid, right? So that we're decreasing our financing costs on the other side. Because now, instead of a 3% loan, that loan might be 6%, might be double the cost to finance that same AR, that same accounts receivable. On the other side of the coin, what Andrew mentioned to me, and I thought this was interesting, he said, listen, we want to keep great vendor relationships. So we want to pay our vendors on time. But for those vendors who aren't asking for it, who don't need it, why don't we pay them 15 days later, 20 days later? And he was talking to me about a specific company that does about $30 million a year in revenue. And for them, that extra 15 days added almost $1 million in cash.
Wow.
Yeah. Just paying your vendors 15 days later. Mm-hmm. And those were vendors that weren't going to be upset that you paid them 15 days later, right? So you've got to think about the relationship, but that light bulb went off as you were saying that.
Yeah, absolutely. I actually have a client that charges customers basically, they're leveraging an excess cash position, which you and I have talked about in previous bonfire chats. And what we're doing is we basically let customers pick their terms: 10 days, 0%, 30 days, 1%, 60 days, 2%, so on and so forth, up to 90 days. So they're going to pay us and we're going to charge them that percentage on every invoice that goes out. And then you and I, Matt, were on a call the other day with a client and, consulting company, and learned that they don't charge late fees. And we're like, whoa, you got to get a late fee in there. You've got 15-day payment terms. There's got to be a late fee.
Well, that's right. And this particular business that you're talking about is doing $25 million in revenue, and everybody's starting to pay them 10, 15, 20 days late. Well, imagine if you just earned a 1% late fee on $20 million, that's an extra $200,000 to your bottom line. Not to mention the fact that people are probably going to pay you faster. Right?
Exactly. It's like, that's the heads win, tails win.
Exactly. Either way, you're winning. So that's great. I love that. All right. The last of your buckets here, Bonnie, was business planning. Talk to me. Obviously, TGG way for business planning is to do an annual business plan and then reforecast every quarter. Talk to me a little bit. We're almost here at the end of Q2, another day, and then we're done with half the year. What are the things that you're talking to your clients about right now?
We're talking about all the things that we're talking about today. We are looking at building out scorecards. So in addition to kind of our monthly financial reporting, building out scorecards where we're looking at things like we've talked about today, the cash operating cycle. So basically our AR versus AP, setting new targets, right, that are, really, really focused on liquidity and profitability. So we're just really looking at how can we improve and revise our planning, or at least what we're tracking based on what we're seeing today.
Yeah, I think that's an interesting thought. Obviously we do monthly financials for everybody, but there's a bunch of our clients who don't get weekly dashboards or biweekly dashboards. And I think it's an important point to in certain businesses, they're so steady, monthly is fine, right? In other businesses, they're so volatile that you need something on a weekly basis. And I would argue that inside of the accounting department, even something like sales leads, like the beginning of a sales funnel, are you tracking that sales funnel on a weekly basis? Because I think that sales funnel and that conversion cycle from a lead to an opportunity to a proposal to a whatever your sales funnel is, I think we got to start to look at tracking this, because again, we need to know where our backlog is so we can start to order properly. We got to think about locking in prices. You talked about establishing, getting a sales order in, but then not delivering until later, and maybe you get stuck with a bad price, right? So if we have more predictability, I think those weekly or biweekly dashboards is something we really ought ought to discuss with our clients even more, because in this volatile environment, I can see it being very valuable.
Yeah. And like I said at the beginning, really looking at what are we good at, really looking at what is less risky, right? A lot of what we've been talking about today, we've said risk about a dozen times. And so looking at how can we make things less risky, more predictable.
And this is really interesting that you say that, because Bonnie, the other thing that I've been talking to our clients around is how, even if your business is not a recurring revenue business model, how do you make it look like a recurring revenue business model?
Yeah.
And really something that I've been preaching is a bit new, but I got it from another book that I had read called A Retention Pipeline. And I've been preaching this now for a couple of years, which is looking at your existing customers and what is the process that you go through to retain them. We have a sales pipeline. What is the process we go through in the conversion cycle to get a new one? But what is that process that we go through to retain them? What are you doing steps 1 through 5, and what percentage fall off at each spot? Because we really want to get aggressive with retaining and expanding revenue. And you said something that I think is fascinating, which is risk, right? Reducing risk. But the beauty of reducing risk is it actually increases the business's valuation.
Yeah.
Decrease.
For sure. Because that predictability.
That's it.
Yeah.
So often people are like, well, that sounds defensive. I don't mind taking risk. I'm a risk taker. I'm an entrepreneur, business owner. We all take a tremendous amount of risk, but the more you can decrease that risk, the more you increase the value of the business. And that's that paradox, heads I win, tails I win, kind of thing again. So very cool. All right. Anything else, Bonnie, on your mind here that we should make sure we address with everybody before we get to some questions?
We've covered a lot. I think we could go ahead and get into questions, and then if something else comes up throughout that, I'll chime in. Okay,
super. So before we start to dive into questions, and I will do that here in just a second, Emily, I think, is going to put a slide up here for us, our contact slide. There we go. So if you're listening in here today and you would like to get 30 minutes with either Bonnie or myself, we will take a look at your books, analyze them, analyze the accounting accuracy, look at how they're presented, look for business opportunities, talk to you about what we see in them. If that's what you'd like, please make sure you email us. You've got my email address there, you've got Bonnie's, or you can just put your email in the chat right now and we'll make sure and reach out to you to schedule that. All right, a couple of questions here as we dive in. Let me see where we're going to go. Sorry, I got a bunch of questions. Okay, Bonnie, how do you deal with this? Was, I think, going back to your comment about knowing the supply chain. Yeah. How do you figure that out? They asked the question was directly about international supply chain, and how do you figure out how far back the international supply chain goes?
Yeah, I mean, what is that they say? Like, did you Google it?
It's amazing what you can find, isn't it?
Yeah, I mean, it is. And again, it's also about having the relationship with the vendor to be like, who are you guys buying from, right? Even your competitors or other people in the industry that you've met at trade shows, whatnot. Knowing your industry and people is important. And then, yeah, I find almost everything on Google that wouldn't be, an accounting rule that I just know from 5 years of school. So.
Yeah, it's amazing. I actually had to Google an accounting rule yesterday.
No way.
It's 100% true. I thought I knew it. It was about capitalization of software. And I thought I knew the rule. Turns out I knew 95% of the rule, but there was 5% that actually really helped our clients out by me diving in and doing some more research on Google. So I think that's interesting. Are you able to find then like your customers, vendors on Google and say, or do you have to reach out to them?
Depends. Both, right? So it depends. And some of it too might be like, look, we don't know who their actual supplier is, but we know the inputs to their product, right? So that's really the point. We know the inputs, so we can look at the inflation rates for those inputs, right? So it's going to be like paying attention to Fed announcements and really looking at not just that blended inflation rate that we all see and we all talk about all the time, but the specific rates, right? Which you can get a CPI, PPI index online.
Yeah. Okay. That's great. I think that's really good. I love that idea of understanding your vendors and understanding the supply chain to get full view of inflation up and down your supply chain. Another question that we have here is, what is the risk of stagflation? So first and foremost, I'm going to just define what stagflation is for everybody so that we're all on the same page. And then I'll give you my 2 cents, and I'd love to hear yours, Bonnie. So stagflation is where you have inflation and a recession at the same time. What is our risk of stagflation? I would tell you we're in it. The last quarter, we're going to find out in July. So in about another month, we're going to find out whether the economy contracted a second quarter in a row, which is technically a recession. But we've had inflation the entire time, and we had 1 quarter of negative GDP growth. So I believe that we are in a stagflation environment today. That's going to be my argument. And that, in fact, we're going to continue with that. So what does that mean? It's really the worst of all worlds. And I'm not trying to be a pessimist in there, because I believe there's a ton of ways to make money in a stagflationary environment. But you've got to make sure that you're dealing with people who can pay you. Because what happens is you're finding consumer credit levels are increasing significantly. Default rates on credit cards are increasing. Deposits at banks are evaporating, where a year ago, banks had so much money, they couldn't lend it out fast enough. Now deposits are being drawn down, which means consumers are spending their savings, right? That's literally what's happening. And so I think we've got to really be careful here to know our numbers every single day, work in longer term contracts. Like you say, really get that risk down to a minimum and go out and grow our business in this opportunity. But I'll let you kind of give your opinion. What do you think? We're in a stagflationary environment? Are we in a recession, Bonnie? What are you seeing with your clients?
Oh my gosh, it's like, these are like bad words, you know, nobody wants to say out loud. Yeah, I mean, I try to be optimistic and realistic. I mean, you know, depending on my client's personality, some are like, yeah, we're in it. Some are like, it's coming. Some are like, it's not. So we're, again, like when we're talking, we're really doing all the things we talked about today. We're looking at what is our capital structure. We are looking at our operating cash cycle. That's so important. We are really—
Bonnie, can I stop you there? What is it? Can you define operating cash cycle for everybody?
Yeah, oh gosh, the actual formula, Matt.
Well, no, I'm just saying, like, what does it mean for people?
Yeah.
Right? Because the way I understand it is it's the amount of money you have to outlay right now to get a product until the time you sell it and then collect on it.
Yeah.
Right? So whether it's a service, you're paying a salary to somebody, they're doing work, then you're billing it, then you're collecting it. What's the time between you have to outlay money until you get it?
Yeah.
That's what I see as is that a reasonable definition?
Yeah, spot on. Right. And so this just tells you, yeah, how long from when you spend money does it turn into cash for you in terms of what you're offering?
And obviously we wanted to do this, but
yes.
how many of your clients are now asking, or are you suggesting, before it didn't really matter, wasn't in inflationary times, we weren't losing any money with this, but now are you suggesting your clients track this on a monthly basis or even more frequently?
Yes.
From end to end?
Yeah, from end to end. And because of the risks you're talking about, right? Slow paying customers would be a reason that would extend. Vendors tightening up their terms, right, might be a reason that would extend. Yep. Getting shorter would be if customers are paying us faster, or if we're paying vendors slower. So you mentioned a great point that Andrew made on kind of almost vendor segmentation, right? Like we talked about customer segmentation earlier. You know, and then I've got a consulting client that has, you know, a negative cash cycle, which is actually a positive thing.
Right. They get paid before they do the work.
Yeah. They get paid before they have to pay for the resources, which is—
It's interesting you mentioned that, though, because a lot of people don't think it's possible, but I want to tell the story of Amazon, because that's how Amazon survived the .com bust. Amazon had a negative cash cycle, which means they were collecting cash from the people they were selling stuff to before they paid the people who they bought the goods from. That's what saved them, because they were positively cash flowing. They were growing and growing, but they were losing all kinds of money, but the cash flow was coming in, and that's what saved them in the .com. Amazon could easily be pets.com. Let's just, right? But instead they're Amazon.com. And we think of them as this big, huge, powerful company because everyone in the industry said, you can't get a negative cash cycle being in retail. They said, no, we can. And they did it. And I think it's important that we think that through if we're coming into a recessionary, stagflation, or even just an inflationary environment.
Yeah, absolutely.
All right, a couple other questions here, and then I think we're about out of time. I got one that's sort of an interesting one. Appreciate the offer on the financials. What does the 30-minute consultation actually look like? Can you go through that? Because another person asked me what the name of the retention book was, and I'm going to look it up on my phone right now. But I'm going to look down and find this on my Audible.
Yeah, a 30-minute consultation will be the most productive if you're able to bring your financial statements with you and share your screen. We'll meet over Zoom, introduce ourselves, look at your financials, and Matt and I will kind of go through and tell you where we see risk and where we see opportunities. And it's also a chance for you to tell us, what are your pain points, what's going on, and to ask us kind of questions about what we do. And then maybe that best case scenario, maybe that leads into us having a partnership together.
Cool. All right. Thank you, Bonnie. I did find this on Audible. It did not take me too long because this was another suggestion, again, from my partner and one of our CFOs, Andrew Ruff. The book is called Never Lose a Customer Again by Joey Coleman. Never Lose a Customer Again by Joey Coleman. And I have read this thing at least 4 times on kind of loop on my Audible. So something worth checking out. They do talk about, I may be bastardizing the way he talks about it. I've kind of put it into my own words, but that retention funnel and a retention process for retaining customers and retaining good customers. All right. Well, Bonnie, we've kind of come to the end of our day here. There are a few other questions. If people, again, are interested in that consultation, please put your email into the chat. If we didn't get you your question today, I apologize. You feel free to email me or Bonnie directly. Yeah. You have our email addresses there. We would be happy to help you in any way we can. Appreciate everybody's time today. Bonnie, thank you so much for your expertise and advice and all you do for your clients and for us at TGG. So thank you all very much, and we will see you next time. Bye-bye.
Thanks, Matt.
Thanks.